Alright, dear students, in this lecture we are going to discuss the agency theory. Now, why we are discussing this agency theory? Because we have to understand the concept of the financial statements and the concept of preparing the financial statements. Now, in the previous lectures, you have studied that business is an activity, a legal activity undertaken to generate profit. This is the thing we have already discussed. In the types of business, we have discussed three types. The one is the sole tradership. The other one was the partnership. And the third one was the limited companies. And within the limited companies, we have discussed that there are two types of limited companies. Public limited companies, those companies whose shares are available on the stock exchange and their shares are available to the general public. And then there are private limited companies. So there are the private limited companies. Now, in the sole tradership, there was the unlimited liability. In the partnership, there is unlimited liability. But in the limited companies, as the name suggests, the liability is limited. The shareholders, who are the owners of the company, are only responsible up to the investment they have made. They are not responsible for more than that. So limited companies, they are a legal entity. The company is an artificial person, and we have discussed the features why the company is known as the separate legal entity and why the sole tradership and partnership are not called as separate legal entities. We have already discussed that thing in the chapter number 1, which was introduction to the business. Now we are talking about the agency theory. Now, agency theory is the relationship between the principal and the agent. Agency theory is the relationship between the principal and agent, and if you talk in the context of companies, shareholders are the principals and directors are the agents. Now, what is the context of this thing? Now, we know that in the context of companies, if you talk about the principal, who is actually the shareholders, they are assumed to be a layman. Now, layman means that they have investment, but they do not have the expertise, they do not possess expertise, or they do not have the time or competence, etc., to run the company. Now, this is the general thing. Although there are companies in which the shareholders are managing their companies, that is the private limited companies. But generally, when we talk about the companies, we are talking about the public limited companies. So the principals, who are the shareholders, they are assumed to be a layman. You will see many people around you. Those people are having the money, they are having the investment, they are rich people from their family background, but they do not have the expertise, they do not have the qualification, or they do not have the time to run the company, to manage their own company. So what they're going to do is they will hire the directors, agents, to run the company. So the shareholders are going to trust the directors, and they will be giving their investment to the directors to run the company on their behalf. So it is the responsibility of the directors to maintain the trust of the shareholders, to maintain the trust of the shareholders. Trust of the shareholders. And do not let them down, do not break their trust, and maximize the shareholders' wealth. Take decisions which are in the best interest of the company. Best interest of the company and the shareholders. So the context is that there is the agency theory, which is the relationship between the principal and the agent. In the companies, the principals are the shareholders who are having the investment. The directors are the agents who are running the company on the shareholders' behalf. Because shareholders assume to be a layman, they do not have the time, expertise, or competence to run the company. That is why they are going to hire the directors to run the company on their behalf. That's fine. So it is a responsibility of the directors to run the company in the best interest of the shareholders. They should try to maximize the shareholders' wealth. And in response, directors will be getting the remuneration. In response, the directors will be getting the remuneration. Now, the remuneration means that they will be getting the salary, they will be getting the bonuses, they will be getting the benefits, they will be getting share options, pensions, etc. So, actually, they are not working for free. Shareholders are giving them the huge amount of money, huge amount of remuneration for running the company. So when they are getting the remuneration, then it is their primary responsibility to take decisions which are in the best interest of the shareholders. Try to maximize the shareholders' wealth. Now, how would the shareholders know? How would the shareholders know that how well the company is performing? How would the shareholders know that how well the company is performing? Because they are sitting outside the organization. Directors are running the company, shareholders are sitting outside the organization. So how would the shareholders know regarding the position? Position means financial position of the company. Now, whenever we talk about the financial position, that means how many assets the company possesses, how many liabilities are there, how much is the equity. Similarly, they need to know regarding the financial performance of the company. They need to know what are the revenue or what is the sales. They need to know what is the profitability because they have invested in that company. So the shareholders are looking for the financial performance and financial position of the company. They need information regarding financial performance and financial position of the company, how much cash the company has, how much profit the company is making, everything. Now, the directors will be preparing the report. Directors will be preparing the reports for shareholders, which shows the financial performance as well as the financial position of the company. So directors will be preparing the reports for shareholders which shows the financial performance and financial position of the company, and these reports are known as the financial statements. These reports in which there is the financial data regarding the performance and position. These reports are known as financial statements. So, preparing financial statements is the responsibility of directors, or you can say managements. So this is the concept of the financial statements, that why the directors will be preparing the financial statements. Now we will be discussing that what type of financial statements we do have in the companies and why there is a need to prepare and publish the financial statement. But this was the basic idea, that the financial statements are mainly prepared for the shareholders.